Hello and welcome to Livewire Markets. I'm Anna Dadich. Today I'm joined by Caroline Kai, CEO of Pzena Investment Management. She's going to be talking to us about the Pzena approach to value investing. Hi Caroline, thanks for joining us.
Hi Anna, thank you for having me.
Great. Pzena is famous for its deep value and contrarian approach. So for those of us who don't know, can you tell us about how Pzena thinks about value?
First off, we think value just means you're sensitive to the price that you pay for something. We'll be the first one to say we want to buy good businesses at a low price. Who wouldn't? No manager wants to buy bad businesses or pay a high price for it. So our view is, then what's the consistent inefficiency in the market that gives you the opportunity to do that? We think that's when something bad happens to a good business that's obvious to everyone. But the resolution of that negative development or event is not obvious or certain. That's usually the point where what can go wrong in the business is largely reflected in the valuation already. But what can improve, through management ingenuity, self-help, and so forth, is not necessarily in the valuation. So we're really looking to expose our clients to skewed risk-reward trade-offs in a given business and build a portfolio of different businesses that all have that characteristics individually, but are, as we say, in pain for different reasons, and therefore the fix will be different as well. That way, we don't need a crystal ball about the future because 60% of them working out to the upside, the collective outcome at the portfolio level will be very good. That's how we define value.
Okay, so how has that approach held up in the recent market volatility?
Yeah, so value, deep value, what we do is really trying to take advantage of the human emotional response to negative development and the desire to see the future as certain and knowable. We kind of take the view that the only thing you know for sure is the price you pay for something. So for us, taking tariff as the example, what we're focused on is how does the tariff and the different scenarios that can play out translate for the specific businesses that we're looking at. Let's understand what's the pricing power, what's the shift in the relative positioning of the company, and then looking at the price that we're paying, saying, do we have that asymmetry in risk-reward trade-off that we're looking for? Now, I will say, despite the volatility, there hasn't been a whole lot of actions in our portfolio, partially because the market has been somewhat indiscriminating in selling everything. And frankly, the direct impact of tariff, which is actually easier to quantify, is pretty transparent and obvious, and it's not that significant for most of the businesses that we're exposed to. I think what the market is concerned about is the slowdown in macroeconomic development, the recessionary potential, and inflationary impact. That's something that we've gone through multiple cycles around as a deep value investor. There have been a lot of recessions, for the years that we've been doing this, and it's pretty straightforward. You focus on 5 years out what this company is capable of earning once they get to the other side of the economic cycle, and are we paying a low price relative to that 5-year out earnings potential? If we are, then we would be happy to add to the position. And that's what we've been doing. We're adding to some specific positions in the portfolio, taking advantage, for the most part, actually company-specific development, not necessarily what's been thrown up by the tariff debate.
Okay, so this recent market volatility, how does it compare to other cycles you've seen in your investing career? And I guess if you could lay out a base case for, what comes next.
The tariff debate is unprecedented. If you look at even at the base case that everybody is operating at now, which is 10% rate across the board, this will be the highest tariff for U.S. imported goods since 1940. So it's been a long time since we've seen that. And the broad-based nature of it means the impact is probably more significant than people anticipate. On the other hand, we've always viewed management, sort of human ingenuity, as what sits at the core of what makes value investing work as well. People react to negative development, then figure out how they improve things through their own sort of what we would call self-help. And it's in that improvement, it creates the opportunity for us to generate good returns by paying a low price for the business. I think it's precisely in moments like this being focused on understanding how this business specifically can adapt to different environments. That really provides the compass for us in making the decision of, are we buying this business with sufficiently low valuation so that even in the worst case scenario, there's a lot of the downside that's already being reflected in the valuation, and therefore the risk of permanent capital impairment is minimized in the process.
So I wanted to talk about one of your recent slide decks. There were two slides that stood out, and I was hoping you could talk about their importance and also what the information conveys to investors. So I'll start with the first one. It's the global cheap stocks offer real returns in inflationary times. If you could talk about that one first.
Yeah, sure. That one is fairly straightforward. It really comes down to, first of all, businesses are run by real human beings. So the business outcome is not a function of what shows up on your spreadsheet. It's really how people react to the environment. Therefore, when you look at stocks, by and large, they outperform bonds in an inflationary environment, because with bonds, it's not doing anything, right? With stocks, companies figure out, how do I need to raise prices? How do I cut costs to generate higher earnings to deal with the inflationary environment? Now, specific to value stocks, what's also interesting is, because value stocks are already discounting a lot of pain, kind of a lot of the downside from economic disruptions, more likely than not have already been reflected in the valuation. That's where, as a result, when you go through these high inflation period, value stocks actually work pretty well. Really just given the fact that you're paying a low price for the long-term business outcome, and as inflation picks up, it has less, and most of the cash flow is front-loaded. As inflation picks up and interest rates pick up, it's less impactful on value stocks versus kind of longer duration growth stocks or the more expensive end of the market, for example.
Yeah. Okay, so in the second one, value has favourable drawdown characteristics. If you could talk about that one.
When we looked at the data going back to the 70s, if you look at the chart, what it basically says is, when you have drawdown events, on average, pretty much everything goes down at the same time, over the same time frame. So you can look at it and say there's no place to hide, or you can say, well, it's really, if drawdown is the concern, it's not clear there's any part of the market that outperforms the others within the equity market. But I would say, let's think about it a little differently, which is, unless you need access to your money in the next 12 months, what's important from an investor's perspective is really the resilience of the portfolio. So this is where value, I think, distinguishes itself, at least based on historical observations. The future can be different, but we don't think human emotions have changed that much. So observing history has a lot of teaching for us. And if what you see with value is it recovers much faster versus other parts of the market, and then you look at the 5-year total returns from the peak of the market, looking forward 5 years, value outperforms other parts of the market by a meaningful amount. So I sort of think of it as, investors are always thinking about, how do I protect myself from the drawdowns? I'm not a surfer, but I've watched enough documentaries to kind of have a basic idea of things. You have a choice. You can try to outrun the big one, or it's impossible, or it's very expensive to do that. So what matters is actually how quickly you get back on the board after you've been knocked off. And I sort of think about the recovery of value in a similar fashion. Having a resilient portfolio, what matters is how quickly you recover from the drawdowns, and then over the long period of time, what's the expected return from the strategy.
Let's shift focus now and talk about the portfolio. What changes have you made since the start of the year, and why?
It's interesting because April was highly volatile, but we didn't see wholesale change in the opportunity set, so the activities actually wasn't that exceptional. But over the last year or so, I would say, the area where we've been adding to from an exposure standpoint are healthcare. And we've been taking gains in areas like financials, where some of our holdings have performed very well, and adding to healthcare, where we are seeing really businesses that have a long history of good profitability coming under earnings pressure, and as a result, their valuations have collapsed And we have a view that the risk-reward trade-off looks very interesting. In emerging market, we've taken some gains in our China exposure because China has recovered quite strongly since the beginning of the year. And we've continued to add to regions like Brazil, where we see the macro concerns really giving us the opportunity to own some of very high quality franchises at low price.
One of your investments at the moment is Samsung, a company that's seen its share price fall by about 30% over the past year. What are you seeing that the rest of the market isn't?
So everybody knows Samsung for their handsets and the TVs, sort of home appliances and so forth. But really what's at the core of Samsung is their memory business that powers everything we do in the electronic sort of computing world. So Samsung historically was the undisputed leader in memory. And they were the ones who were always at the leading edge of cost reduction, what's called a node migration for semiconductor production. Then two things happened in the last couple of years that's really pressured earnings in their memory business. One is we just have a classic supply-demand imbalance in memory. COVID led to a big increase in consumer electronics demand. And Samsung got carried away and invested a lot of capital in expanding that capacity. So right now we're sitting on a surplus of memory capacity, and that's pressured pricing and led to sort of depressed earnings in the conventional memory business. That one, we see ongoing growth on the demand side. We see the producers pulling back on CapEx, so it will fix itself in the next couple of years. It's just simple math, right? Then the new challenge, which is unique this cycle, is in this area called high bandwidth memory chips, so HBM. These are the chips that go with your GPUs, so the NVIDIA GPUs that power the AI data centers. For a number of reasons, Samsung missed the transition to the leading edge of HBM. So Hynix, a competitor they've had for many years in the memory business, has been the monopoly, essentially the monopoly in HBM supply. And given the boom in AI spending, that's a business that's highly profitable today. And investors are making the judgment because Samsung has missed the last transition, Samsung is going to be behind perpetually, and that's what you see in the valuation. It's being priced as if they'll never catch up to Hynix. We think the gap in the performance of Samsung and Hynix can be fixed. They can catch up to Hynix, and it's in the interest of NVIDIA to find multiple suppliers versus having a monopolistic vendor. And the gap in kind of what caused the underperformance for Samsung, some of it is strategic decision-making going back in history. Some of it, does it have anything to do with the chairman being in prison and therefore decision-making was slowed down? Probably a little bit. It's hard to definitively say this is what happened. But the gap is not so insurmountable, unlike what divides Intel and TSMC on how they make leading edge chips. We do view this gap as more likely to get fixed. If they fix it, this is home run on the return side. But we never thought they should fall behind. So we fully accept it's possible we got it wrong and they stay behind forever. However, the nice thing about value investing is you look at something when what can go wrong has already gone wrong. And that's what you see in the valuation. And that's really the upside that we see in Samsung. And it's got a good balance sheet, so you don't worry about it going through a downturn and having potential financial issues. And ultimately, there's the underlying earnings power of the conventional memory business and all the other things that Samsung does, handset, appliances, and so forth. So it's a fairly typical case of the type of asymmetry that we look for. If it doesn't get better, not a whole lot of downside. If it does improve, tremendous amount of upside potential.
So how does Pzena think about risk in the value investing environment?
We really think risk from a long-term capital owner's perspective and from a long-term business owner's perspective is really the permanent impairment of capital, not the daily price volatility. in that company. So really think about risk as what are the things that can lead to a different range of outcomes for this company. And when you think about kind of how do you incur permanent capital impairment, it's usually two things. One is you overpaid for something where the earnings were not there. We're value people, so we rarely get accused of that. And the second one is there's a permanent shift in the capital structure of the company, so your equity claims is no longer valid. Or there's real obsolescence risk that came through in the business. Most people, think of as structural disruption. That's where we're focused on. So on the capital front, we're very sensitive to balance sheet risk. We generally don't expose ourselves to sort of a high leverage situation because our view is we're focused on the long term, what this business should earn. But if you have a lot of debt, what happens in the short term is very important. And we could be right about where the business is 5 years from now, but we may have zero claim to that long-term earnings. And we have a process for making sure that we're delevering the balance sheet of the businesses we're looking at in a systematic way. So at least you're not just screening up things that look cheap because it's excessively levered. On the business front, it's really making sure that you fully understand what made this business great in the first place, what's changing relative to that historical source of value add or profitability, and then what are the available avenues for improvement over time. That's what the research is about at the end of the day. And then we look for as many different things as possible, because our view is we have sufficient humility to say there's always a grain of truth in every bear case. The market is not that inefficient. But what we're trying to take advantage of is not that we're going to be right 100% of the time, but rather even when the downside case plays out, it's 20, 30% potential downside that we're willing to tolerate. But on the upside, we're looking for 60, 80, and 100%. So it's focused on what's the range of outcome, skewing that as much in our favor as possible by paying a low price today, and then building a portfolio of different businesses that have different source of pain and hence upside potential. To us, that's a way to build a deep value, concentrated portfolio of good businesses that are all selling for low valuations, but managing the risk of you're just forecasting one thing happening into the future.
So what's your final message to investors who are considering investing with Pzena?
We would say, we've been very, very true to our value discipline. So we're building a concentrated portfolio that looks different from the benchmark. So there will be short-term volatilities in our performance versus others. But on the other hand, I also think, our view is everybody should have value in their portfolio because it provides a different source of alpha generation versus maybe a lot of the other managers that are out there looking at the more growthy end of the market. The one thing that I think is important to recognize is when we say deep value, all we mean is we're buying companies at a low valuation. And equally important is we're trying to buy good businesses. We're not out there looking for cheap and terrible businesses. It's sort of some of my colleagues get really hurt by the conversation where people go like, "Oh, you're deep value, you must be buy junk in the market." That's not what we do. We're very much focused on what's a good business, understanding what's gone wrong today that's led to the low earnings and low valuation, and then really focused on do we fully understand the range of outcomes embedded and also at the portfolio level have as many different things built in as possible. We think a volatile environment, an uncertain environment actually is quite favorable for value because that's what we do to look at uncertain situations and again, make sure we pay as little as possible upfront. The last one that I would say different in our mind that's a little different is if you look at what we're paying to buy the collection of businesses in our portfolio today, it's right in line with what we've paid historically to build a deep value portfolio. So we're paying no more than the long-term history. And when you compare that to the rest of the market, pretty much in every other asset class, you're paying a lot more today than you did historically. We're a firm believer that the starting point valuation is the best indicator of long-term expected returns. So from that standpoint, we're very happy with the starting point of deep value, which is highly differentiated relative to the rest of the market.
Okay. Caroline, thank you so much for sitting down with Livewire today and sharing your insights and expertise. I really appreciate it.
Oh, thank you for having me.
No worries. Looking forward to your next trip to Sydney.
Thank you. It's been wonderful.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel where we release new content every week.